40 heroes, 62 zeros. 6 heroes, 17 zeros. If all the stock picks can't even beat the index, then all of this is a moo point.
A moo point?
Yeah, it's like a cow's opinion. It just doesn't matter. It's moo.
Welcome back, mindful investors. As you can see here, I've generated several spreadsheets to track the performance of the monthly stock picks. The results are in, and it doesn't look promising. Let's see. The algorithm for the spreadsheet is fairly simple. Find their stock pick video, put down its price at the first of the month, then compare to the current price, and benchmark it against whichever index they're in. Voila! Let's fast forward through this tedious process, shall we?
6.5 hours later.
On average, the stock pick failed to beat the index at a ratio of 2 to 1, meaning that for every 3 picks, 2 of them will lose to the index. Here are some of the best and worst picks. The best ones being Tesla, Apple, Nvidia, and Facebook. The worst ones would be GoPro, Funko Pop, Wynn Resorts, Applied Optoelectronics. In GoPro's instance, we have minus 68%, and Nasdaq during the same period was up 116%, meaning the performance against the benchmark is a whopping 184% over the past 4 years. To put it into perspective, if we had invested $100,000 in the stock, you'd be left with $25,000 instead of having $284,000 if you only had invested in the broad Nasdaq index. And this YouTuber had recommended the stock for 16 months straight. Ouch. In the real world, we tend to vet someone before we can trust them. If you're a property owner and you're looking for a tenant, you normally perform a series of validations, criminal background checks, getting their employer pay stubs for the past 3 months, previous landlord recommendations, and maybe even a friend referral or two. Why don't we do the same with the people we trust online, especially when it's related to money matters? Then I think a little bit deeper about this quote from the Founder movie.
Is there a problem? A big one. You don't seem to realize what business you're in. You're not in the burger business. You're in the real estate business.
Let's change that quote a little bit to fit our situation. You don't realize what business you're in. They're not in the investing business. They're in the entertainment business. With that perspective in mind, things are much clearer. If we don't care about the performance of the stock picks or have any fiduciary duty with the viewer, then we can endlessly push flashy stocks from Tesla, NEO, Snowflake, Rocket, Lemonade. Whatever the next big thing is, because we only care about making headlines to draw eyeballs and clicks. We already know for a fact that 89% of the fund managers fail to beat the market. They have all the smart Wall Street guys earning millions a year and spending tens of millions developing AI algorithms that can decipher through all the numbers like EBITDA, EPS, forward-backward projections within minutes. Wait a second, I think they have it all wrong. The best and the brightest investors are on YouTube, not Harvard, Wharton, or MIT. These guys can recite The Intelligent Investor line by line and dig up insider news like no one else. Being able to read is one thing. To truly understand is a completely different story. Even the people working inside the company cannot gauge how well the 100 moving parts are synchronizing, let alone a person looking in the dark. Here are 4 things I learned after going through hundreds of these videos. We have limited resources in life. Therefore, we need to invest our time and money wisely. These entertainers are not only draining our time with the daily videos that can drive our emotions one way or another, some are even building this trap as the stock master to sell you their courses. After knowing that the track record of picking the winning stock is 1 in every 3, would you still buy their courses? Just because they made hundreds of stock picks and one of them went 10x in a year, it doesn't mean they're the greatest of all time. This couple from Prince George has won the lottery for $20 million. Would you ever buy a mastery course from them named Step-by-Step Guide to Winning the Lottery? Number 2, find the proper tool to learn the skill. The idea of watching these stock pick videos is kind of like getting the training wheels on your first bike. It might seem like a great idea because you get to ride on your own without any learning curve. The hardest part of biking isn't the act of pedaling, but the act of balancing. In order to learn that, we'll hop on a Strider, a bike without pedals. That way we can focus on what really matters and fail until we learn on our own. Just like everything in life, the best way to learn is to fail. Then we go back to the drawing board and work on the fundamentals. Eventually, you'll carve out your own unique path. Number 3, build filters. You can call me a skeptic because I've seen dozens of scams over the years. A ton in China, many in Craigslist and YouTube since the business is very scalable and profitable. As Tokyo says in The Money Heist, what you can't see is much more important than what's in front of you. There are a lot of illusionists out there painting the perfect picture to sell you their products. Is it a surprise that several of the successful YouTubers were real estate agents? Their best skill is to sell people for commission all their lives. I found this article titled, "Are Realtors Snakes?" The short answer is no. I have some good realtors who are not reptilian and I'm happy to put you in contact with. However, the long answer is that many realtors exhibit strong snake-like tendencies. Realtors have shown some of the worst ethics in any profession I've encountered. I have to agree with that on many levels. The YouTube business is no different. The finance sector has by far the highest CPM, meaning they get the most money for every click. Affiliates like WeBull are willing to shell $150 plus for every client they onboard. Number 4, law of averages. While I was compiling the spreadsheets, there was a commonality between several channels. The number of stock picks per month has increased drastically over time. Starting in 2017, the titles were 3 stocks to buy this month. Then in 2018, we have 3 stocks to buy this month and 3 stocks I'm watching. Now in 2020, we have 3 stocks I'm buying, 3 stocks my grandmother's watching, 4 dividend stocks to hold forever, 7 growth stocks you can't miss out on. The obvious reason is to draw more views by creating more videos. But another reason is to have the law of averages working in their favor in twofold. Number 1, the more stocks we pick, the closer to the market average or performance will be. This also deters people like myself from compiling the huge spreadsheet in order to show the true returns. Number 2, if we're picking 100 stocks every couple months, then we're bound to find the unicorns that will skyrocket. After that, we can use them as a star case study and sell our stock picking abilities. Being a mindful investor requires the ability to see past all this bullshit. Comment, like, and subscribe if you found any value. Take care, and I'll see you in the next one.